to the seventh episode of Sterling Digest. It has been a while since we had one of this. Now we're into the fourth quarter of 2024. The reason for absence, maybe nothing really, just we have been busy, especially with the banks. The stock market seems to have picked up and the economy is on its path to recovery. Maybe since we last met, maybe you can catch up a bit, Davis. Our last episode was in May or June. What has happened since?
So apparently I've become lighter since then. But I'd left for a while because of my own studies. But now I'm back. So glad to be back with the team.
Maybe you should tell us what you're studying.
Studying CFA. Trying to get my charter. So that takes up a lot of time and energy. If you ever start it, you'll see.
So the trick with Davis is he always says it's difficult just to, it's
when I'm getting my results, I'll go and leave. So how things have gone.
So that's how he hedges. He says it's difficult, so when he passes, he says he outlived his, or outperformed his expectations. What about you?
When Davis was on leave, I was just holding fort with Ronaldo. Been a bit busy with the banks, as he said. Otherwise, nothing much.
Not much has happened since. We've been fairly busy. Like I mentioned, the banking sector has taken a lot of our time. A lot of things are happening in the banking sector or the economy since also the political environment has been very edgy since we last did one of these episodes. So today we're going to discuss the half-year banking sector performance review and an outlook for 2024. We sent out a report earlier this month. The first bit of the report was covering the macroeconomic performance. The second part was covered the performance of the respective banks. So any highlights in terms of the economy? The main one was high interest rates in 2024 compared to 2023. We saw the CBR has been at 13% for most of the year, revised to 12.75 a month ago. But interest rates have been comparatively higher this year compared to last year. In terms of the banks, any specific things we noticed about the banks?
Maybe Isabel can start us on.
A lot was happening for the banks. And just to continue from the high interest rate point from Ronaldo, the impact of that by the banks was, extremely high interest income. However, it was sort of dissuaded investors from, borrowing. So it saw a bit of cut in the loan book. But there are other reasons as to why the loan book cut, which was an outlier event because usually loan book and holdings drive the asset base. So the other was, the FCY foreign currency loan portfolio declined because of the depreciation, appreciation, yes, of the shilling against the dollar primarily. So then the other thing probably was high interest expense across the banks with the and high margin compression. That led to a decline in NFI a bit because of the appreciation of the Kenya shillings. I don't know, should we just repeat? I'm just tired.
Should I get it? Davis, like we titled our report, margin compression, Isabella touched a bit on it. High interest rates, high interest expense, which reduced the margins. We saw also banks struggle to grow the profitability above double digits. Do you have anything further to add to that?
Yeah, just to agree in that interest income was pretty high, just as all banks I believe have received approval for their risk-based pricing models, and so there was that, but it was offset by the fact that interest expenses have been growing really fast. So there's quite a bit of margin compression across the board. On the NFI front, remember in 2023 there was a lot of dislocations in the FX market, dollar shortages and the like, which meant that spreads were extremely wide. But now, because this year, after the refinancing of the Eurobond that was set to mature in June, after that, the dollars just flowed into the market, the shilling strengthened quite materially, so spreads compressed quite a bit on the FX market. So that means that banking margins came down, FX income has been coming under pressure for specific banks, like let's say NCBA, which NFI to net interest income is almost 50-50. So that all trickled down to impact on the operating income line. Yeah, so those are the trends we've been seeing. Yeah.
Thanks for that. We're going into the last quarter of 2024. That starts in October. Maybe we should cover the outlook. Any views on how the banking sector will perform in the last quarter, or let's say for 2024? What do you expect of banks?
Yeah. So considering it's just one quarter left, I expect current trends to just continue. Like you won't see a material shift in the fourth quarter, but we do expect interest rates to start coming down. So at least margins for banks should start widening, and you see that trend more materially in 2020. Time for adjustments to be made, but basically what we expect to see is for interest rates to start coming down. So the CBK to start reducing the central bank rate, that's the CPR, in line with global entities like the Fed doing so. So what you'll start seeing is deposit rates coming down. So interest expenses will start to, at least the pressure will be relieved to some degree. And then now after that, you'll see margin expansion rather than compression. But you'll see this more materially in 2025 rather than now. But the trends in the FX market, we would largely expect them to remain the same. So a lot of pressure for specific banks because the margins are being compressed, but the volumes are really picking up.
Yes, I noticed one bank following the revision of the CBR Equity Bank reduced their base lending rate. But I suppose banks would leave their lending rates at least elevated, while deposit rates will come down in response to the downward revision of the CBR, and also T-bill rates have started declining. Isabel, there's something that also, maybe to give some background, NPLs at the end of June was 16.3%. That is non-performing loans as a proportion of total banking sector loans compared to 14.8%. Any views on this increase in NPLs?
Yeah, so generally speaking, the macro environment has been very tough for businesses. So that in turn has affected their ability to pay up the loans that they've gotten from the bank. So that's why you've seen high non-performing loans since the year began, and we are not expecting much difference for the remaining 3 months of the year. And I guess the primary bank that's been driving this was KCB. For the first half of the year, primarily it's mainly been legacy loans that have been affecting KCB's NPLs, but they're working on it, though we still feel like it's going to be a tough one for KCB. And we've noticed that mostly it's been quite difficult for the banks to recover these loans because of the long court processes, and it takes time to recover your collateral, etc. So it's going to be tough for the banks to recover these non-performing loans.
Thank you for that. Maybe a bit of the performance of the NSE. Let me go to the performance of the NSE. The NSE showed some signs, or good signs of recovery in 2024, the first half of 2024. Just the NSE 20 at about 10%, plus 10%, and the NASI at at 20%, following poor performance in 2022, 2023, and the first half of 2023, which was negative 6% for the NSE 20 and negative 16% for the Nairobi All-Share Index, which is the NASI. In terms of banking sector share prices, banks performed well year on year, with I&M at 26%, that's plus 26% when you look at year on year performance. Standard Chartered at 21%, and all banks with the exception of DTB returning positive growth. Davis, any banks that stand out in your view?
In terms of share price performance, it's been good performance across the board. We've seen foreign interest starting to pick up, particularly on KCB, just given that it's the largest bank in Central and East and Central Africa, and it's trading at around 2 times earnings if you prorate earnings into the full year. So that's been quite attractive. I believe that, as well as the NBK sale, have driven up the share price. For Standard Chartered and other banks, it's likely been on the back of dividends. Yeah, so then we expect this trend to continue next year as well, because banks should do record earnings going forward, but also just pegged on how their level of provisioning will be. For underperformance, of course, of the DTB, as we mentioned many times, the ROE is quite low. They seem to have that capital allocation issue, and so the underperformance will likely continue going forward.
Yeah, just to add to that, banks seem to have performed consistently well despite their general poor performance of the economy. Like you said, KCB stands out. They didn't have a very good year last year. They withheld a dividend, they paid interim dividend, and the expectation is that the dividend will be good in at the end of the full year. But what's stopping these banks from performing, or the share prices have not really moved in tandem with the performance of the banks. What's your outlook for the NSE? Do you think the NSE will bounce back now that interest rates, global interest rates are declining, or what do you think will trigger a recovery of the NSE?
Yeah, that's a good question. Right now, it's very interesting. So a lot of trading in our markets is occurring on the basis of retail investors. In fact, you'll notice that the best performers, it's likely because retail have piled in. Local fund managers have largely stayed away from the market. On their end, the feeling or the sentiment is that they need a rally for them to step in, so that they don't announce poor performances and have issues with their trustees. So local fund managers are out, but retail investors are really plugging in. Hence why you see counters like EPLC Kengen doing quite well. Now, the reason companies are doing well is on the basis of largely dividends, because retail investors are quite short-term in nature. They just see good earnings announcements, see the dividend, they plunge in, then they get out. But also on the preemption that good dividends will continue, the share prices have continued to trade quite well, even ex-dividend. So they'll drop and then they'll pick up again and trade above where they were before that ex-dividend date. Going forward, the hope is that foreign investors will come back on the basis of interest rates coming down globally, which would make asset classes like equities more attractive in emerging and frontier markets like Kenya. But now that's really does depend. If there's a systematic shift, it may not happen. In that, you'll notice over the past few years, investing in African equities has been difficult, and yeah, also bonds, because you're a foreigner, you come to Kenya, so you convert your USD into KES, for example, or whichever African country currency. Now that African country has a lot of USD debt, so that means that the currency will always depreciate as they convert their local currency to, for example, foreign currency to pay off debt payments if they don't have the FX to do so. And so foreign are coming in, they're an FX trader, so they're always at a losing position, and then equities haven't done well for so long. A lot of foreign funds have closed, so it doesn't make sense to invest in Africa as a whole. That's been the trend for the past few years. So we hope that it's not a systematic shift that has occurred, but by foreigners only invest here on the basis of they have a mandate. So they have investment policy statement that says you must invest 35% of your portfolio in Africa. And a lot of guys have been shifting away from that and just saying, okay, we'll look at Africa, we'll look at other places just because of underperformance, the difficult environment, hyperinflation, FX, just a number of different issues, unfortunately. Yeah. So that hope is that they'll come back on the basis of interest rates coming down. That should drive the market up. Retail investors will always be there, then local fund managers follow. But if there's a systematic shift, it would largely be retail investors driving things up, and for very short periods of time, because dividends, then they move out.
Thanks for that. Maybe this is more of a personal question. Maybe, Isabel, where would you put your money in, considering we're still in an environment of high interest rates? The NSC seems to be showing some signs of recovery, but not maybe very strong growth. Where would you put your money today?
I've always put my money in bonds since beginning of last year.
As an active bond trader, or you've taken buy and hold?
Oh yes, buy and hold. But I know that those who've bought, who do like active trading, etc. Probably Davis.
In bonds?
Yeah.
Oh.
No. Okay. Yeah. So I just do buy and hold. In terms of the banks that we cover, I'm positive about KCB's performance. We're expecting good dividends from them, so probably I'd also consider buying. But yeah.
Davis, yourself, I know you don't like bonds.
Not that I don't.
Or you prefer equities to bonds?
Yeah,
Let me rephrase that question.
Yeah, I prefer equities because the upside is quite high. So interestingly, it's a very controversial thing, but KPLC is quite attractive, and the basis is that last year they made a loss of 3.2 billion, but this year they should do profits of around 16 billion. The reason is they won't have an FX loss that they did last year. The FX loss last year was slightly shy of 17 billion, and imagine that FX losses are passed through, meaning we as the citizens pay. So them they are hedged from FX losses. The only reason they don't pay dividends is because the current ratio has been low, but this year it has been below 1, and they have debt covenants that state that it must be above 1, but this year it's highly likely to be either at 1, really close or slightly above. So that's an attractive stock. And then when you consider the fact that the government told all parastatals to pay out 80% of the earnings as dividends, hypothetically, if they announce a dividend of in excess of 8, they pay out at least 6, hypothetically. But if not, I guess they go back to their historical dividend of either 0.5 or 1, because now they're about to do record earnings. Yeah, so it's worth the view, but also considering just how high risk it is, the best thing is maybe to have an investment holding period of at least 2 years, because that's when all their debt covenants fall off, and so they must pay out a dividend at least by 2026.
Okay.
Yourself?
Myself, I look at 18% in an IFB, no tax, consistent income. I think it's a good investment. Money market has become a very popular investment option for Kenyans. So I've seen even banks going into asset management, the most recent being Stanbic, the convenience of also investing through a bank and even through the mobile phone, the USSD, or through apps like Standard Chartered with reputable companies like Sanlam. I think those are good investment options, but you expect the rates to come down and also the return to come down. So in that sense, I think for me, capital protection is more important than taking a bit of risk, or maybe a balanced portfolio. So I think I'll put my money in those two.
Yeah, it's an age thing.
Yeah, it's an age thing. Davis has a longer time to live, and he can take no risk to recover his money in case he loses it. So I guess that brings us to the end of Sterling Digest episode 7.